Big banks, big bets. Barclays and Goldman Sachs dive into crypto. In a move that has sent ripples through the financial world, these two banking giants are making significant investments in the cryptocurrency market. This isn't just a passing interest, it's a strategic plunge into the future of finance. Wall Street is placing big bets on Bitcoin. The buzz on the trading floors is palpable as traders and financial analysts discuss the implications of these massive investments. Bitcoin, once considered a fringe asset, is now being embraced by the mainstream financial community. Barclays and Goldman Sachs, two of the world's biggest banks, are pouring money into Bitcoin ETFs. These exchange-traded funds are designed to track the price of Bitcoin, allowing investors to gain exposure to the cryptocurrency without having to buy it directly. It's a way to hedge their bets while still participating in the potential upside of the crypto market. These are like baskets of Bitcoin, traded on stock exchanges. They offer a way for investors to buy into the cryptocurrency market with the added security and regulation of traditional financial markets. This hybrid approach is attracting a lot of attention from both institutional and retail investors. Barclays invested a cool $131 million. This substantial investment signals their confidence in the long-term potential of Bitcoin and other cryptocurrencies. It's a bold move that could pay off handsomely if the market continues to grow. Goldman Sachs went even bigger, dropping a whopping $1.57 billion. This massive investment dwarfs Barclays' contribution and underscores Goldman Sachs' aggressive strategy in the crypto space. They are clearly betting big on the future of digital assets. That's a 121% increase from their previous investment. Such a significant increase highlights the growing confidence and interest in the cryptocurrency market among major financial institutions. They are not just dipping their toes, they are diving in head first. This is a really big deal. The involvement of such prominent banks lends credibility to the entire crypto ecosystem. It signals to other potential investors that cryptocurrencies are not just a passing fad, but a viable asset class with substantial growth potential. These banks are not buying Bitcoin directly. Instead, they are opting for a more measured approach by investing in Bitcoin ETFs. This strategy allows them to benefit from the cryptocurrency's price movements without the complexities and risks associated with holding the actual digital coins. They are investing in ETFs. These financial instruments provide a way to gain exposure to Bitcoin while enjoying the regulatory oversight and security of traditional stock exchanges. It's a safer and more familiar route for these large institutions to enter the crypto market. Why? Because ETFs are seen as a more regulated and secure way to get exposure to crypto. They offer a layer of protection and oversight that direct investments in cryptocurrencies lack. This makes them an attractive option for risk-averse institutional investors. It's like dipping their toes in the crypto pool without jumping in head first. By investing in ETFs, these banks can test the waters and gauge the market's performance before making more substantial commitments. It's a cautious yet strategic approach to entering the volatile world of cryptocurrencies. This is a sign that institutional investors are getting more comfortable with crypto. The involvement of major banks like Barclays and Goldman Sachs indicates a growing acceptance and recognition of cryptocurrencies as legitimate investment opportunities. They see the potential for big returns. The rapid growth and increasing adoption of cryptocurrencies present a lucrative opportunity for those willing to take the risk. These banks are positioning themselves to capitalize on this emerging market, and they are willing to put their money where their mouth is. By making these significant investments, Barclays and Goldman Sachs are demonstrating their belief in the future of cryptocurrencies. It's a bold move that could reshape the financial landscape and pave the way for broader acceptance of digital assets. Abu Dhabi is quickly becoming a global hub for all things crypto. The Emirates Sovereign Wealth Fund, Mubadala Investment Company, invested over $436 million in BlackRock's Bitcoin ETF. This is a clear signal that Abu Dhabi is serious about becoming a major player in the crypto space. Abu Dhabi's government is creating a friendly environment for crypto businesses. They are developing regulations that are clear and business-friendly. This is attracting a lot of crypto startups and investors to the region. Abu Dhabi is also home to a growing number of crypto exchanges and trading platforms. This makes it easier for investors to buy, sell, and trade cryptocurrencies. So what exactly are Bitcoin ETFs? Bitcoin ETFs, or exchange-traded funds, are financial instruments that allow investors to gain exposure to Bitcoin without having to directly purchase and manage the cryptocurrency themselves. They are designed to track the price of Bitcoin and are traded on traditional stock exchanges. Imagine a big basket full of Bitcoin. This basket represents the ETF, which holds Bitcoin or Bitcoin futures contracts. By investing in the ETF, you are essentially buying a portion of this basket. Instead of buying Bitcoin directly, you can buy shares of this basket. These shares represent a fraction of the total Bitcoin held by the ETF, making it easier for investors to gain exposure to Bitcoin without dealing with the complexities of owning and storing the cryptocurrency. These shares are traded on stock exchanges, just like regular stocks. This means you can buy and sell them through your brokerage account, making the process familiar and straightforward for traditional investors. This makes it much easier for institutional investors to invest in Bitcoin. Institutions often have strict regulations and guidelines that make direct investment in cryptocurrencies challenging. Bitcoin ETFs provide a regulated and accessible way for these large investors to participate in the crypto market. Bitcoin ETFs offer several advantages over buying Bitcoin directly. For one, they eliminate the need for investors to manage private keys and digital wallets, which can be a daunting task for those unfamiliar with the technology. First, they are regulated by financial authorities. This regulation ensures that the ETFs adhere to strict standards and provides a level of oversight that is not present in the unregulated cryptocurrency market. This provides investors with a level of protection. Knowing that their investment is overseen by regulatory bodies can give investors confidence and peace of mind. Second, ETFs are more liquid than Bitcoin itself. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. Bitcoin ETFs being traded on stock exchanges offer high liquidity. This means that investors can easily buy and sell their shares. They can quickly enter or exit their positions without worrying about the market's depth or the potential impact on Bitcoin's price. Finally, ETFs are managed by professional fund managers. These managers are experienced in handling large portfolios and can make informed decisions about buying, selling, and holding assets within the ETF. These managers take care of the complexities of buying, storing, and securing Bitcoin. They ensure that the ETF's assets are safely stored and managed, reducing the risk for individual investors. This gives investors peace of mind. By investing in a Bitcoin ETF, they can benefit from the potential growth of Bitcoin while avoiding the challenges and risks associated with direct ownership. The influx of institutional money is having a major impact on the crypto market. When big players like Barclays and Goldman Sachs invest in crypto, it gives the entire market a boost of legitimacy. It's like a vote of confidence from the financial establishment. This increased demand is driving up the price of Bitcoin and other cryptocurrencies. Bitcoin recently hit a new all-time high, and many analysts believe that this is just the beginning. The more institutional investors that jump on board, the higher the price of crypto is likely to go. This is creating a virtuous cycle for the crypto market. Higher prices attract more investors, which drives prices even higher. Section 5. The allure of Bitcoin, ETFs, safety and simplicity in a volatile world. The crypto world can be intimidating for new investors. It's volatile, complex, and full of technical jargon. Bitcoin ETFs offer a simpler and potentially safer way to get involved. Investors can buy and sell shares of a regulated financial product. They don't need to worry about the technicalities of managing their own crypto wallets. This ease of access is attracting a lot of people who were previously hesitant to invest in crypto. It's opening up the market to a whole new wave of investors. This is further fueling the growth of the crypto market. Section 6. Abu Dhabi's Crypto Ambitions, a hub for the future of finance. Abu Dhabi is positioning itself to be a leader in the global crypto revolution. The Emirate is developing a comprehensive regulatory framework for crypto assets. They are attracting crypto businesses and talent from around the world. Abu Dhabi's government recognizes the transformative potential of blockchain technology. They are investing in research and development to explore new use cases for blockchain. They are also working to foster a thriving crypto ecosystem in the region. Section 7. Beyond Bitcoin. Will institutional money flow to altcoins? Bitcoin is currently the darling of institutional investors. But what about other cryptocurrencies known as altcoins? Will they also benefit from this influx of institutional money? Some analysts believe that institutional investors will eventually start diversifying their crypto holdings. They will look beyond Bitcoin to other promising altcoins. This could lead to significant price appreciation for a wide range of cryptocurrencies. However, it's important to note that altcoins are generally considered to be riskier than Bitcoin. They are also more susceptible to market manipulation. Institutional investors are likely to be cautious about investing in altcoins until the market matures. Section 8, the regulatory rollercoaster crypto's wild ride continues. The crypto market is still in its early stages of development. Regulation is one of the biggest challenges facing the industry. Governments around the world are grappling with how to regulate cryptocurrencies. Some countries are embracing crypto, while others are taking a more cautious approach. This regulatory uncertainty is creating a lot of volatility in the market. A change in regulations can send crypto prices soaring or plummeting. This is one of the biggest risks that investors need to be aware of. Section 9. The future of crypto, a world powered by digital assets. The crypto market has come a long way in a short period of time. From its humble beginnings with Bitcoin in 2009, it has grown exponentially, capturing the imagination of investors, technologists, and the general public alike. The journey has been marked by significant milestones, including the introduction of Ethereum, which brought smart contracts into the mainstream, and the rise of numerous altcoins that have diversified the market. What started as a niche technology has evolved into a multi-trillion-dollar asset class. This rapid growth has been fueled by a combination of technological innovation, speculative investment, and increasing acceptance by mainstream financial institutions. The market capitalization of cryptocurrencies has soared, reflecting their growing importance in the global financial ecosystem. The influx of institutional money is a sign that crypto is here to stay. Major financial players, including hedge funds, investment banks, and even pension funds, are now allocating portions of their portfolios to digital assets. This institutional interest not only provides liquidity, but also lends credibility to the market, encouraging further adoption. Cryptocurrencies have the potential to revolutionize the way we think about money and finance. They offer a decentralized alternative to traditional banking systems, enabling peer-to-peer transactions without the need for intermediaries. This can reduce costs, increase transaction speed, and provide financial services to the unbanked and underbanked populations around the world. They could create a more open, transparent, and efficient financial system. Blockchain technology, the backbone of cryptocurrencies, ensures that all transactions are recorded on a public ledger, making it nearly impossible to alter or manipulate data. This transparency can help reduce fraud, increase accountability, and build trust in financial transactions. The future of crypto is bright, but it is also uncertain. While the potential benefits are immense, the market is still in its infancy and faces numerous challenges. Regulatory uncertainty, technological hurdles, and market volatility are just a few of the obstacles that need to be overcome for cryptocurrencies to achieve their full potential. The market is still evolving, and there are many challenges that need to be addressed. Regulatory frameworks are still being developed, and there is a need for greater security measures to protect against hacks and fraud. Additionally, the environmental impact of cryptocurrency mining is a growing concern that needs to be addressed through more sustainable practices. However, one thing is clear: crypto is a force to be reckoned with. Its transformative potential is undeniable, and as the market matures, it will likely play an increasingly important role in the global financial landscape. The journey ahead is filled with both opportunities and challenges, but the impact of digital assets on our world is just beginning to unfold.